This is today's market update. U.S. stocks ended lower as Middle East tensions flared again, and oil prices moved higher. The S&P 500 fell for the first time in 10 sessions. That ends a powerful run of record highs. The market is now dealing with two forces at once. One is geopolitical risk. The other is the inflation pressure that comes with higher oil. Even so, AI is still holding the market together in important places. Meta rose after launching a paid AI agent for businesses. The Philadelphia Semiconductor Index gained 1.4%, showing that AI demand is still strong underneath the weakness in the broader market. But not every AI name is moving the same way. Broadcom disappointed investors after giving a weaker outlook after the close. That matters because it shows the AI trade is starting to split. Some names are still strong. Others are being judged much more harshly. That split is also visible in the wider market. Software stocks lagged. Big tech was weaker, and managers are starting to care more about positioning, valuation, and what comes next. At the same time, the real economy is still firm. The May ADP private payroll report showed 122,000 new jobs, better than expected. That tells us the labor market is still resilient. Consumers still have support, and the economy is not rolling over yet. But that strength creates a problem for the Fed. Dallas Fed President Lori Logan said rates may need to rise later this year if inflation does not cool. New York Fed President John Williams said policy is in the right place for now. So the central bank is not speaking with one voice. That matters because inflation is being pushed not only by demand, but also by oil. Higher energy prices raise transport costs, shipping costs, and food costs. That makes inflation harder to control. So the message today is clear. The market is not in a clean risk-on mode anymore. AI is still strong, but it is no longer lifting everything equally. Oil is pushing inflation back into the story, and the Fed is facing a more complicated policy picture. The big question now is whether this is just a pause or the start of a more selective market. For now, investors are still buying AI strength, but they are also becoming far more sensitive to earnings, oil, and rate risk.